This is Japanese Economic Review Channel. Looking back at yesterday, July 17th, the Japanese market experienced a historic correction. The Nikkei 225 plummeted by 2,694 points, driven by a perfect storm of global tech weakness and regional regulatory shifts. While the headline loss is significant, we must analyze the structural mechanics of this liquidation to understand the current sentiment heading into the new week. Yesterday was a defining risk-off day. The Nikkei closed at 64,141, but the real drama occurred at 1:41 p.m. when it hit an intraday low of 62,704, a staggering drop of 4,130 points. This reflected intense selling pressure that peaked midday before a slight narrowing of losses due to short-term oversold sentiment. Investors aggressively moved toward safety across nearly all asset classes. Three factors engineered yesterday's drop. First, U.S. tech weakness on the 16th set a negative global tone. Second, South Korea's new leverage ETF regulations led investors to use Japanese semi-stocks as a proxy for regional risk while Korean markets were closed. Finally, broad position squaring occurred ahead of Japan's three-day Marine Day holiday weekend, accelerating the afternoon slide. A tech paradox on Wall Street late Thursday set the stage for yesterday's contagion. Despite TSMC beating Q2 profit expectations, its ADRs dropped due to aggressive profit-taking. This triggered a sector-wide slump in the U.S., dragging down highly correlated stocks like SanDisk and Western Digital. This negative momentum flowed directly into the Tokyo market at the open. The internal dynamics of the prime market yesterday showed overwhelming breadth in selling. 1,081 stocks declined, roughly 70% of the market, while only 449 advanced. Trading value reached a massive 10.92 trillion yen. This ratio illustrates a severe market breadth contraction, impacting portfolios far beyond the semiconductor sector as localized risk-off sentiment triggered a mass exit. We saw a clear divide between heavy losers and defensive winners yesterday. Semiconductors, financials, and metals like Kioxia, MUFG, and Mitsui Mining were hit hard by the risk-off wave. Conversely, capital fled to safe havens, boosting shipping firms like NYK Line and pharmaceutical giants like Chugai and Daiichi Sankyo. This rotation suggests that while sentiment is cautious, capital remains selective. The Growth 250 index also suffered yesterday, breaking below the psychological 700-point threshold for the first time in 2 weeks. Major names like Astroscale and Timee saw significant declines as risk appetite vanished. However, Terradrone managed to resist the downward gravity, proving that unique corporate stories can still find support even during a broad market liquidation. Yesterday ended with the Nikkei at 64,141 and the yen at 162.22. Despite the market turmoil, fundamental innovation continues. Companies like Junior East are advancing hydrogen hybrid HYBARI trains for 2027, and Shimadzu launched a pioneering diagnostic kit. These advancements remind us that while prices fluctuate, industrial and technological progress remains the long-term anchor for the economy. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.